Hi everyone, welcome to my channel. In this video, I'll be explaining the 20% pass-through deduction in detail by going over the flowcharts with examples on how to compute these deductions under different scenarios. It is imperative that you have watched and understand part 1 of the two-part video where I discuss the main rules, the theories of what this deduction is all about. These videos are designed to help you understand the rules and how to apply these rules to determine how 20% deduction work. I added this table for quick reference, but I decided to create a flowchart so we can see how these calculations work. As I mentioned in part 1 of the video, your deduction depends on the type of work you do. So you have to ask yourself, is it a specified service business? If the answer is yes, then you have to ask, is taxable income over the threshold? $157,500 for single and $315,000 for married filing joint. If the answer is no, then you get the full deduction, which is your 20% of your QBI. If the answer is yes, then your next question is the taxable income over the full phase out, which is $207,500 for singles and $415,000 for married filing joint. If the answer is no, then your 20% deduction is subject to the phase out where you have to compute wage and capital test. If the answer is yes, then you will receive no deduction whatsoever because you have completely phased out. If your business is not a specified service business, then your next question is taxable income over the threshold? Again, $157,500 for single or $315,000 for married filing joint. If the answer is no, then your deduction equals 20% of your QBI. If the answer is yes, then your next question is taxable income over the full phase-in, which is $27,500 for single or $415,000 for married filing joint. If the answer is no, then the 20% deduction is subject to phase-in of your wage and property limitation. If the answer is yes, then your deduction equals lesser of 20% of your QBI or the greater of 50% of your wages or 25% of your wages plus 2.5% of your qualified property. For the purpose of calculation of the deduction, your W-2 wages equal to wage expense, and it does not include guaranteed payments or payments to independent contractors. For the purpose of qualified property, it has to be tangible, both real and personal property being depreciated, but it does not include land. And the depreciation period is the later of the regular depreciation period or 10 years. And your unadjusted basis equals to basis immediately after acquisition, and it does not reduce the basis by bonus depreciation and Section 179 expensing. In this example, L is single and operates dental practice as a sole proprietorship. His business earns $100,000 in qualified business income during the year. He also earned $32,000 in investment income and took the $12,000 standard deduction. His total taxable income is $120,000. That is $100,000 of his QBI plus $32,000 of his investment income minus his standard deduction of $12,000 to come up with $120,000. So you ask, is it a specified service business? Since dental practice is part of the specified service business, the answer is yes. Your next question is taxable income over the threshold? Well, his taxable income is $120,000 for single filers, so the answer is no. Therefore, the deduction is 20% of QBI or $20,000. If your taxable income is within the $157,500 or $315,000 threshold, that's all there is to the pass-through deduction. You are effectively taxed on only 80% of your business income. In this example, L is married and files jointly. He earned $745,000 in taxable income this year. His sole proprietorship dental practice earned $745,000 and paid $100,000 to employees. So the question, is it a specified service business? Because it's a dental practice, the answer is yes. The next question is taxable income over the threshold? Since he's married and files jointly, you have to look at $315,000 of the threshold amount. And his taxable income is way over the $315,000, so the answer is yes. Now, is the taxable income over the full phase-out? Again, for married filing joint, it's $415,000, while his taxable income is $745,000, so the answer is yes. Therefore, he gets no deduction whatsoever because it has completely phased out. Okay, if your business is a non-service business and your taxable income is between $157,500 to $207,500 for single, or $315,000 to $415,000 for married filing jointly, the wage and property limitation is phased in. That is, only part of your deduction is subject to the limit and the rest is based on 20% of your QBI. The phase-in range is $100,000 for married and $50,000 for singles. So if you subtract $157,500 from $207,500, that's $50,000 phase-in range for singles. And if you subtract $315,000 from $415,000, that's $100,000 range for married. So for example, the limit would be 50% phased in for married taxpayers with taxable income of $365,000. So if you subtract $315,000 from $365,000, that's a $50,000 difference. Now, at the top of the income range, which is $27,500 for singles and $415,000 for married, your entire deduction is subject to the wage and business property limit. Thus, if you have no W-2 wages or business property, you get no deduction. So to calculate the phase-in, first determine what the amount of your deduction would be if the wage and property limit didn't apply at all, which will be the 20% of your QBI. Next, calculate your deduction as if the wage and property limit applied in full. Your phase-in amount is based on the difference between these two calculations multiplied by your phase-in percentage. So for example, L and I are married and operate a restaurant as an LLC. Their QBI this year is $345,000 and the business pays $100,000 in wages and owns no property. Okay, so in this calculation, their phase-in percentage is 30% because their $345,000 QBI is $30,000 over the $315,000 limit. Their deduction, if the W-2 wage and property limit didn't apply, would be 20% of their $345,000 QBI, which equals $69,000. Their fully limited deduction based on their W-2 wage is $50,000, which is $100,000 wages paid, multiply that by 50%, and you come up with $50,000. So they should lose 30% of the difference between the full deduction of $69,000 and the fully limited deduction of $50,000. The difference amounts to $5,700. So if you look at the calculation, you subtract $50,000 from $69,000 and then multiply that by 30% phase-in percentage, and you will come up with $5,700. Thus, they should lose $5,700 from the full $69,000 deduction. So L and I can take $63,300 pass-through deduction on their return. Now, is your business a specified service business? If the answer is yes, is your taxable income over the threshold, $157,500 or $315,000? If the answer is yes, then it's taxable income between $157,500 to $207,500 for single. Now, if you notice, there's a $50,000 range. $27,500 minus $157,500 is where the $50,000 range comes from. And for married, the range is $315,000 to $415,000, $100,000 range. If the answer is yes, then the deduction equals lesser of 20% of your QBI or the greater of 50% of your W-2 wages or 25% of W-2 wages plus 2.5% of qualified property. If you have no employees or depreciable business property, you get no deduction. And to calculate the phase out of the deduction, if you have employees or property, your deduction is phased out by 1% for every $1,000 your income exceeds the $315,000 threshold. And when your income reaches $415,000, you get no deduction. And if you're single, your deduction is reduced by 2% for every $1,000 your income exceeds the $157,500 threshold, and you get no deduction if your income reaches $207,500. To understand the previous example better, let's assume L is married and files jointly. He earned $345,000 in taxable income this year. His sole proprietorship dental practice earned $345,000 and paid $100,000 to employees. His $345,000 taxable income is $30,000 over the $315,000 threshold. Before the phase out, his deduction is limited to 50% of the W-2 wages he paid, which was $50,000. Since his phase out percentage is 30%, which is $30,000 over the range of $100,000 for married filing joint, he gets 70% of the full deduction, which is 70% times $50,000 or $35,000. In this example, we have a rental business. A rental business is considered a non-service business. Let's assume Jen earned $350,000 in total taxable income during 2018. She has no employees in her rental business. Thus, her pass-through deduction is limited to 2.5% of the purchase price of the long-term property she uses in her rental activity. This consists of her duplex, which she purchased 6 years ago. Her depreciable basis in the duplex, which is purchase price minus the value of the land, is $100,000. Her pass-through deduction is limited to 2.5% of $100,000 or $2,500. The 2.5% deduction can be taken during the entire depreciation period for the property, which is 27.5 years for residential property. However, it can be no shorter than 10 years. Here's the basic rundown of the business deduction. The deduction is generally available to owners of pass-through businesses, including real estate. The deduction cannot exceed the lesser of QBI amount or 20% of your total taxable income minus your capital gain. I hope the flowcharts and examples provide some guidance on how to calculate the pass-through deduction for your business. If you like this video, please subscribe and give me a thumbs up.